The possibility to pick bottoms during a crash seems scary. Prices fall fast, and headlines scream doom, and even experienced investors feel the urge to panic. But crashes also create opportunities. For stock pickers, a downturn can be a chance to buy quality assets at discounted prices. The trick is knowing how to spot the right opportunities without falling into traps. Let's break down how to approach stock picking during a crash and what it means to pick a bottom wisely. Understanding stock picking. Stock picking is the art of selecting individual stocks rather than buying the whole market through index funds. It requires research, patience, and a clear strategy. Good stock pickers focus on companies with strong fundamentals, like healthy profits, low debt, and competitive advantages. During stable markets, this process is challenging enough, but during a crash, it becomes even harder. Fear and uncertainty can distort prices, making some stocks look like bargains when they're actually value traps. The myth of perfect timing. First, let's address a common misconception. No one can consistently time the exact bottom of a market crash. Even professionals rarely get it right. Trying to buy at the lowest point is like catching a falling knife. It's risky and often leads to mistakes. Instead of aiming for perfection, focus on buying when stocks are undervalued relative to their long term potential. This shifts the mindset and reduces pressure and helps you make rational choices. How to spot quality during chaos. When markets crash, even great companies get dragged down with weaker ones. This is where research pays off. Start by looking for businesses with strong balance sheets. Companies with little debt and plenty of cash can weather downturns better than those drawing on loans. Check if the company is still profitable or has a clear path back to profitability. Avoid firms relying on constant borrowing to stay afloat. Next, consider the industry. Some sectors, like utilities or consumer staples, tend to be more stable during recessions. Others, like travel or luxury goods, might struggle for years. Focus on industries with enduring demand. For example, people will always need healthcare, food, and basic technology. Companies in these fields often recover fast. While timing the market bottom is nearly impossible, certain signals can hint that a stock is undervalued. One indicator is extreme pessimism. When headlines are overwhelmingly negative and retail investors rush to exit, it often signals panic rather than rational judgment. This can create buying opportunities. Another clue is valuation metrics. Compare a stock's current price to earning ratio to its historical average. If the ratio is far below normal, it might be oversold. Similarly, a high dividend yield relative to past payouts could signal a bargain, but only if the dividend is sustainable. Always check if the company can afford its payouts. Insider buying is another positive sign. If executives or major shareholders are purchasing shares during a crash, it suggests confidence in the company's future. Track SEC filings or financial news sites for this data. Avoiding value traps. Not every cheap stock is a good deal. A value trap is a company that looks undervalued but is actually a long term decline. Falling stock prices might reflect deeper issues, like outdated technology, poor management, or shrinking demand for products. To avoid value traps, ask, is this company's problem temporary or permanent? If the industry is dying or the business model is broken, no low price justifies the risk. The role of patience to pick bottoms during a crash. Picking stocks during a crash requires patience. Prices might keep falling after you buy, and recovery could take months or years. This is why you should only invest money you won't need soon. Emotional decisions like selling in a panic after a further drop can lock in losses. Stick to your research and give your picks time to rebound. Diversification still matters. Even during a crash, don't put all your money into one or two stocks. Spread your investments across different sectors and companies. Diversification reduces risk if one pick underperforms. For example, pairing a billion-dollar tech stock with a stable consumer goods technology balances volatility. Learning from history. History shows markets eventually recover. After the 2008 financial crisis, many stocks rebounded sharply within a few years. Investors who bought quality companies like Amazon or Apple during that turmoil saw massive gains. The key was focusing on businesses with strong futures, not just cheap prices. Study past crashes to spot patterns. While history doesn't repeat exactly, it often rhymes. Not every crash is a buy opportunity. Sometimes the best move is to hold cash and wait. If the overall economy is in free fall with no clear recovery plan, staying cautious is smart. Likewise, if you can't find companies that meet your criteria, don't force trades out of fear of missing out. It's better to miss a rally than lose capital on bad bets. Prepare for crashes before they happen. Keep a list of companies you like to own at the right price. Track their financials, competitive position, and stock performance. When a crash hits, you will know exactly which stocks to target. This proactive approach keeps emotions in check and speeds up decision making. Crashes test your discipline. Fear and greed push investors to make impulsive moves. Stick to your strategy and don't let short term noise distract you. Remind yourself why you picked the stock. It's the fundamentals, not the daily price swings. If your research still holds, trust the process. Final thoughts. Picking stocks during a crash isn't about being a hero or smarting the market. It's about staying calm, doing the work, and capitalizing on others' fear. Look for quality companies with solid futures, buy when prices are reasonable, and hold until the storm passes. Avoid the urge to time the bottle perfectly and never risk money you can't afford to lose. Over time, this disciplined approach can turn market chaos into opportunity. Remember, investing is a marathon, not a sprint. Crashes are temporary, but the gains from well chosen stocks can last a lifetime. Stay patient, stay informed, and let the market ups and downs work in your favor.